Have you ever dreamed of owning your own home here in Canada, but felt like the down payment was an impossible mountain to climb? Well, what if I told you there's a relatively new, incredibly powerful tool that can make that dream a whole lot closer to reality? Today, let's talk about the First Home Savings Account, or FHSA, your new secret weapon in the Canadian real estate game. Let's break down exactly what the FHSA is, why you absolutely need to consider it, the pros and cons, how it stacks up against your other registered accounts like RRSPs and TFSAs, and most importantly, how you can start using it to save for your first home. What is the FHSA? An FHSA is a hybrid of an RRSP and a TFSA, specifically designed to help first-time home buyers save up for that crucial down payment. Contributions you make to an FHSA are tax deductible, just like an RRSP. That means you get a tax break in the year you contribute. Then, any investment growth inside your FHSA, whether it's stocks, ETFs, mutual funds, or GICs, grows completely tax-free. When it's time to withdraw for your first home purchase, that money comes out completely tax-free too. It's a triple win, my friends. Tax deduction on the way in, tax-free growth, and tax-free withdrawals. So, are you eligible? You need to be a Canadian resident, at least 18 years old, or the age of majority in your province, and under 71. Crucially, you must be a first-time home buyer. This generally means you haven't lived in a home that you owned as your principal residence in the current calendar year or in any of the 4 preceding calendar years. This applies to your spouse or common law partner too, if you have one. You can open an FHSA with pretty much any major financial institution. All the big banks, credit unions, and brokerages offer them. Contribution and withdrawal rules. Let's dive into the numbers and rules, because this is where the strategy comes in. Contribution limits. You can contribute up to $8,000 per year to your FHSA. There's a lifetime contribution limit of $40,000. Unused contribution room can be carried forward, but only for 1 year, up to a maximum of $8,000. So, if you contribute $5,000 in 1 year, you'd have $8,000 of new room plus $3,000 of carry forward for the next year, giving you $11,000 of room if you maximize it for year 2. But remember, you can't carry it forward indefinitely, and it only starts accumulating after you open your first FHSA. Unlike RRSPs, there's no 60-day grace period into the next year for FHSA contributions. The deadline is December 31st of the calendar year. As for over-contributing, don't do it. You'll be hit with a 1% tax per month on any excess contributions. Qualifying withdrawals. This is the final part of the FHSA. Here are the requirements for withdrawal from the account. You must be a first-time home buyer at the time of withdrawal. You need a written agreement to buy or build a qualifying home. The home must be in Canada. You must intend to occupy the home as your principal residence within 1 year of buying or building it. You'll also need to complete a Form RC-725, request to make a qualifying withdrawal from your FHSA and submit it to your FHSA issuer. What if you don't buy a home? The FHSA is flexible. If you don't end up buying a home, or if you have funds left over after a qualifying withdrawal, you have options. You can transfer the funds to your RRSP or RRIF tax-free without impacting your RRSP contribution room. You can also withdraw the funds as a taxable withdrawal, but you'll pay tax on the growth and contributions that were deducted. FHSA versus RRSP versus TFSA. Which one when? You might be thinking, okay, but I already have an RRSP and a TFSA. Where does the FHSA fit in? Great question. This is where we get strategic. Let's look at this chart together. When it comes to the FHSA, the main purpose is to save for a first home down payment. With an RRSP, it's for retirement savings, and a TFSA is for any savings goal, including emergencies. For contributions, both FHSA and RRSP contributions are tax deductible, while the same cannot be said for a TFSA. In terms of investment growth, FHSA's and TFSA growth is all tax-free, while the RRSP is tax-deferred. For withdrawals, the FHSA has a tax-free withdrawal for qualifying home purchases, while the RRSP is taxable in retirement. The TFSA is not taxed. For annual limits, $8,000 is the annual limit for an FHSA. For the RRSP, it's about 18% of your earned income up to an annual maximum, and the TFSA is set at an annual fixed limit. In terms of lifetime limit, You can only contribute $40,000 to an FHSA over the course of its lifetime, versus an RRSP and a TFSA where there's no specific limit. For carry forward, with an FHSA, you can carry forward up to 1 year or $8,000 maximum. For the RRSP and TFSA, there is infinite carry forward room. Can you recontribute? For an FHSA, you cannot after qualifying a withdrawal and closure. However, with an RRSP and a TFSA, you can contribute and recontribute if the next year permits and you have the contribution room. The main takeaway is this. If you're a first-time homebuyer, the FHSA should likely be your first priority for saving for your down payment, given the unparalleled triple tax advantage. You can even combine it with the RRSP Homebuyers Plan if you need even more funds. The downsides and complexities. While the FHSA is a great account, it's not without complexities. Here are some nuances you need to be aware of. It's a one-and-done deal. You can only open and use an FHSA once in your lifetime. Once you make a qualifying withdrawal and close the account, you can't open another. Limited lifespan. The FHSA has a maximum lifespan of 15 years from when you open it or until you turn 71, whichever comes first. If you haven't bought a home by then, you'll need to transfer the funds to your RRSP/RRIF or take a taxable withdrawal. No joint accounts. FHSAs are individual accounts. Contributions and deductions are specific to each person, so if you're a couple, you would each open one. Modest contribution limit. While $40,000 lifetime is great, and high-cost housing markets in Canada, it might not cover the entire down payment. Another account to manage. For some, adding another registered account to RRSPs and TFSAs might feel like unnecessary complexity, but for the tax benefits, it can be worth it. US-Canada dual citizens, be warned. The IRS does not recognize the FHSA as a tax-sheltered account, meaning you could face U.S. tax on investment gains and additional filing requirements. Always consult a cross-border tax specialist if this applies to you. No 60-day rule. Remember, contributions must be made by December 31st of the calendar year to count for that year. No January-February grace period like RRSPs. Indirect impact on benefits. While the FHSA itself isn't directly considered income for most government benefits, the tax deduction from your contributions could reduce your taxable income, which in turn might affect income-tested benefits like the Canada Child Benefit. This is an indirect effect, but something to be aware of if your income is close to benefit thresholds. How to use it. Practical steps. Alright, you're convinced. You want an FHSA. So, how do you actually get started and put it to work? First, open an account. Contact a financial institution that offers FHSAs. Your bank, a credit union, or a brokerage. You'll need your SIN, date of birth, and likely some documents to confirm your eligibility as a first-time homebuyer. Second, contribute strategically. Decide how much you can comfortably contribute each year, up to that $8,000 annual limit. Set up regular pre-authorized contributions. Consistency is key, just like with any investment. You can also transfer funds from your RRSP to your FHSA, but remember, this counts towards your FHSA limits and doesn't restore your RRSP room. Third, invest your funds. Don't just leave the money in cash. Just like a TFSA or RRSP, you can invest the money inside your FHSA in qualified investments like stocks, ETFs, mutual funds, GIC, and bonds. Choose investments that match your risk tolerance and timeline for buying a home. Many institutions offer both self-directed and managed FHSA options. Fourth, track your room and contributions. Keep an eye on your FHSA contribution room through your CRA My Account. You'll also need to file Schedule 15 FHSA contributions, transfers, and activities when you do your income taxes for the year you open the account. And finally, make a qualifying withdrawal. When it's time to buy that home, work with your FHSA issuer to complete the Form RC-725. They'll guide you through the process of making that tax-free withdrawal. Common misconceptions. Let's quickly bust some common myths about the FHSA. Myth: the FHSA isn't worth it if you're not sure you'll buy a home. The reality is that it's false. Remember, you can transfer the funds tax-free to your RRSP without affecting your RRSP room. It's super flexible. Second myth: you can never have owned a home to qualify. The reality? Not entirely true. You may qualify again as a first-time homebuyer if you haven't owned and lived in a principal residence for the past 4 calendar years, plus the current year. Third myth, FHSA funds can only be used for the down payment. The reality? Nope. Withdrawals can cover other home buying costs too, like legal fees, closing costs, and even moving expenses. Final myth, you can carry forward unused contribution room indefinitely. The reality? It's only for 1 year, up to $8,000, and only after you open your account. Don't delay opening it. The FHSA is truly a fantastic tool for Canadians looking to buy their first home. It offers incredible tax advantages that can significantly boost your savings. If home ownership is on your horizon, seriously consider making the FHSA a cornerstone of your financial plan. If you found this video helpful, please give it a thumbs up and subscribe for more financial insights, and hit that notification bell so you don't miss out on future videos. What are your thoughts on the FHSA? Let me know in the comments below. Thanks for watching, and I'll see you in the next one.